masterminds. So Stephanie, we really appreciate you joining us today. Thank you for giving up your time. We certainly know how valuable it is, and yeah, we just welcome you to the group, and we do keep them a little bit informal in terms of if someone has a question. Are you comfortable with them jumping in, or would you prefer it to go in the chat box?
No, that's my preference. Just
okay.
Hop in, especially with a smaller group like this, just hop right in.
Okay, perfect. All right, well, I will let you take it away.
All right, thank you. Firstly, I just really want to thank you for having me today to do this, and it's an exciting topic for me. I think you guys chose a really great topic because it's honestly something that comes up at least twice a week for me. I see a lot of businesses do it at the wrong time or not do it at all, do it prematurely, really affect themselves negatively from a tax strategy standpoint because they've the timing of their opt to incorporate just didn't make sense, or it wasn't thought out enough to strategize for tax savings or the financial implications that come along with incorporating. So I love the topic, and I'm really excited to be here with you. I do a lot of work with real estate agents, so I have a really good understanding of your business and the expenses that you incur and sort of just this cycle of business for you. So I sort of created the presentation to be tailored to exactly what you folks do. So I've got a little presentation here with me. And I haven't mastered keeping PowerPoint in view mode when I bounce back and forth. So I do apologize. Every time I come out of the share, it'll start over again, but it's only a few slides, so it shouldn't be too bad. So my name is Stephanie Folahan. I own Premier Accounting and Tax based out of Bedford. It's just a boutique style practice, a few hundred clients, really small mom and pop type style. We don't deal with big businesses whatsoever. I love the self-employed professional. So that was another reason that this opportunity really spoke to me, because I am who you are, exactly the same thing. Every time I sell something, that's the only time I get paid. Just like you, if you don't sell, you don't eat. So I really understand what your struggles are, or the space that you're living in. So I'm going to go over sort of great reasons to incorporate, a whole bunch of reasons not to incorporate, a lot of expenses that come with incorporating, and really the overview of my advice around incorporating is if it doesn't save you tax dollars, your E&O insurance covers all the liability issues that would be in place because of, the liability standpoint. So I'm not going to talk from a legal perspective. I'm not a lawyer, but if you have a partner and you need a legal agreement in place and there's a little more legal component to why you would incorporate, that's not as much factored into why I'm here and what I'm presenting. And it's certainly more numbers motivated what I'll be talking about. So I'll go through the presentation, and as was discussed, I'm completely fine with you jumping in at any point with your questions. And also at the end, I'll certainly stick around as long as needed to answer any questions you have after the fact. Okay, so as I said, this is a question that happens, daily almost in my business. Folks kind of jumping the gun, or their friends said they should incorporate, they know somebody who's incorporated. And I think that's a huge mistake when you get the advice from a friend or somebody that you don't know their entire financial or legal situation. Often that advice is given without the numbers related to why the decision was made. So when you're considering incorporating, it should be very specific to your situation. Though everyone in the room does real estate, your businesses probably look very different from a financial perspective, even if there are partnerships or husband and wife teams, or opportunities to have children on staff and things like that from a tax deferral standpoint. You should really just make sure that your decisions are specific to your business and not advice from somebody who thinks they know what your financial situation is. So firstly, the number one deterrent that I see for clients incorporating is the cost of the structure, the setup itself. So using a lawyer can go anywhere from $1,200 to $2,000. I've seen $4,000 and $5,000 incorporations for real estate agents. And that really came from a lack of understanding of what was needed for the incorporation. So I don't want to say the lawyer took advantage, but maybe oversold what was needed in those situations. So making sure you understand that, you probably really do just need a basic incorporation. So to go to a lawyer that says it's $3,000 or $4,000, that 100% would be significantly more than you should spend based on being a self-employed professional. Now there are also the opportunity to incorporate yourself, which is what I have done, as well as many other self-employed individuals that I work with and know. I will provide you these slides. So you'll see there's a link here to Corps Canada itself. So you hop on, you put in your personal information. Corps Canada provides you with a constitution, as well as your certificate of incorporation. And you take that document along with, there's 3 other forms. I'll provide those to you as well as a resource. You take those to the Registry of Joint Stock on Barrington Street, and you'd be incorporated for a total of $475. And that is a legal corporation in the eyes of the CRA. So I just want to be clear that from the legal standpoint, if you need a complex legal agreement or a shareholder registry that has some complexity, you're a little more complex than just a self-employed individual, I would absolutely consult a lawyer. That wasn't the case for me. So I've been incorporated for 3 years. I've got probably 25 other professionals that I work with that have incorporated themselves, and this suffices for our needs, for all of us. So our E&O insurance is recognized through our self-incorporation through the Corps Can. It's the same website that a lawyer would use too, but obviously significant savings in doing so. So I will provide you those resources at the end. So the accounting costs that are associated with incorporating, so typically another deterrent, is that, sole proprietor tax return. There's probably a few of you in the room who do your own T2125, so the small business activity jacket of your tax return, if you're not incorporated, it's pretty self-explanatory. It gives you the steps to walk through. A corporate tax return is significantly more complex, and I don't actually have any professionals that I work with that I know that are able to do that document themselves. I do work with some professionals that get through the T2125 just fine on their own. And a T2125, which is the personal sole proprietor tax return, can range, $200 to $400. A corporate tax return can range anywhere from $4,000 to $2,000, $3,000, depending where you go. So the bigger firms, the MNP and the Grant Thorntons, that would be the price tag to expect there. H&R Block is somewhere mid-range there. And then the mom and pa's are the lower price tags. So this does not include the bookkeeping cost. Actually, I wanted to show you. I'll just put them in the chat. So I have those forms, the T2125, as well as the T2 forms for you to have a look at, or I'll demo them at the end of the presentation. So these tax costs do not include the bookkeeping fee, which for both sole proprietor or a corporation, there's no reason that you should pay a different charge for bookkeeping for either one. So it is a self-assessing tax system that we have here in Canada. So if you do your own books, like a firm like mine, I'm not sure about H&R Block, and I know Grant Thornton and MMP it's basically by the client. So I have some clients that I won't accept their bookkeeping strictly because I know that it's falsified. So I treat it exactly the same as some of the bigger firms, and not from a liability standpoint, because you're the one that's liable for whatever's reported for your tax return. But from an ethics standpoint, if I know better, I just won't accept it. And there is also, yeah, I have my client example. So those are two folks that I won't accept bookkeeping from, just because in the past I've seen that their numbers don't quite make sense or are probably just not true. So if you're good at bookkeeping and you're very organized, you don't necessarily need a bookkeeper, and incorporating might not be as scary in terms of the bookkeeping perspective. But because CRA requires significantly more information through the corporate tax return, the bookkeeping certainly is more important in this case. And some of the things they require is all of your bank balances, the cash balances, investment balances, shareholder due to or owed from. So there's anything to do with money that is owned by the corporation that has to be reported on the balance sheet. So that's another reason that the bookkeeping is so important for the corporation, and therefore often you have more bookkeeping fees because you have to report more on the tax return itself. So some tax flexibility. So this part isn't about specifically numbers, but more about if you incorporate and you've got a loss in the year, the loss carries forward. If you're a sole proprietor or partnership and you've got a loss, the loss can be used against other income. So if you have a loss, or you have other businesses, sometimes you'll have your hands in a few pots. If there's going to be a loss in any of them, it's great not to create a separate entity, which is what incorporating would do, but to use the losses against other income and reduce your personal tax owing. I've got a client who incorporated a little bit too soon, and he had a $20,000 loss. No, it was more than that. It was probably $40,000 or $50,000 loss on a company he was investing in, and he also had a personal tax balance of $20,000 owing. But because he incorporated, he couldn't use the losses against the personal balance owing, which pretty much would have offset him to zero. So now he's struggling to pay the personal balance, and the corp has gone under. So, just that huge strategy mistake. Somebody, a friend of his, told him he should incorporate. So he did. And here we are, out of business. So the timing of it is hugely important, but it would have been fantastic had he had the opportunity to flip the losses to personal savings. So does incorporating save tax? So I ran one example. This certainly isn't, the be all end all. There are the higher the earnings, the higher the savings is typically how it goes. But there are, things that things to consider in that. So from a financial perspective, I was just going to look at an example of a non-incorporated business. So this means partnership or sole proprietor. So let's use the example of $60,000 of a net profit. So after expenses, the take home is $60,000. On your sole proprietor tax return, you can expect to pay around $18,000 in taxes. And the breakdown of that is the employee and employer portion of CPP. You probably know, if you've all done a tax return before, you're responsible for both in this case. Then you've got federal tax owing of $66.08 and provincial tax owing of $56.08. So again, that is a total of $18,000 in tax. If this business were incorporated, we would have the net profit of $60,000 and the total corporate tax of $69.75. So if you were taking home the entire remaining balance, so you don't leave anything in the bank at the end of the year, there's no retained earnings, you would have either a T4 or a T5 for $53,000. So that's your take home on your T4. So you would have either paid through remittances through the year, $11,272 in tax, or a T5, which has a tax bill of $7,000. So when you combine those, the corporate tax and the personal tax rate, the T4 has a small savings of $235, and the T5 has a little bit bigger of a savings of $4,000. That said, factoring in the cost to incorporate and the accounting fee doesn't necessarily seem like it's worth the effort. On top of that, if you've got young children and you've got childcare costs, you cannot claim childcare costs against a T5. So where the most savings are, if you're still in the parent stage where you've got that cost, you won't be able to claim it and offset that tax bill with that either. So there would definitely be some strategy and probably went into a little bit of a T4, a little bit of a T5, but at the $60,000 rate for $235 in savings or $4,000 in savings, hardly seems worth the effort of the additional accounting costs. So incorporating strategy. So as a sole proprietor, every dollar you make gets taxed. So the total profit, you get taxed no matter what. And in your industry, you've had a significant boom in the last year or 18 months or so. So a lot of you probably paid more tax than you normally do because you had higher revenue than you normally do. And maybe looking back, there was some strategy to save some tax dollars. Had things, maybe you knew a little bit more about where the industry was going, or how things played out wasn't necessarily what was expected. And it sounds like it's probably going to stay this way for another little bit. So I'm a little bit jealous of your industry currently. If you used money that from the profit of your business, you didn't miss out on a ton of tax savings. And I'll elaborate on that shortly. Another opportunity is that with incorporating, you have the option of dividends and payroll. So you do get some flexibility to choose what works best for you and in your business. And there is a lower rate on a T5 than a T4, or simply just paying tax on your personal income. That said, the T5 doesn't contribute to CPP or any of the other, anything else on your behalf. So you obviously don't qualify for EI, for sole proprietor, or incorporation, so you wouldn't have to worry about that expense. But CPP may be of interest to you if you've contributed, your prior career or something you did before you worked in real estate. You may have already contributed a significant amount and want to get that when you turn 65, 40 years from now. So one of the main things to consider is the small business deduction. So this is specific to incorporations, that everything under $500,000 has a small business deduction rate. So it's taxed at a lower rate. So I would guess that there may be some folks in the room that hit the $500,000 mark, but probably everybody's a little bit under that. So all of your earnings will qualify for this deduction, and your corporate tax rate will never be more than the 16 to 18%, because it is a sliding margin, just like it is for personal. The corporation, the more you make, the higher the tax rate, but it's a significantly higher amount than the personal tax. So 96, 97,000 for the personal rate puts you at one of the higher rates. But for incorporation, 500,000 is where the first break is. So the number one reason, I went through this a lot faster than I planned, but the number one reason to incorporate, if you don't use all of the money, all of the earnings from your corp, then there is significant opportunity here. If you use everything you make, it's a complete waste of your time and resources for the extra work. So I personally use this strategy. I pick a paycheck and I stick to it. So it doesn't matter if I've done 800,000 in sales, if I've done $15 in sales. Obviously, if I've done 15, that's what I'm going to live off of. But I pick a salary for the year, and I'm very disciplined about that. And a lot of business owners that we've used this strategy for are the same. So they don't take any extra. They don't do any unplanned spending. Their revenue is up, but their income doesn't necessarily have to be, because the opportunity here is to strategize for either retirement or to use your retained earnings through investment opportunities to grow that money even further. From an accounting perspective, if you are using everything you make, incorporating is definitely a waste of your time and resources. If you want your money to do some work for you and you want to pay less tax, so you want to pick a tax rate and stay there, you want to live in that space. 60,000 is, a great living, or 80,000, anything under 96,000 is sort of the threshold that I use for the professionals that I work with. As soon as we hit 96, we sort of evaluate sort of, their lifestyle and where the money is going, what they're doing with it, and if there's some strategy to just stay at the 96 and stay at that rate, because the next rate is close to 40%. So you'll never be at 40% in a corporate tax rate setting. So it makes a lot of sense to not waste additional money on tax if you don't need to. So I had some things I wanted to show you. Does it show a tax form on the screen, or is it still on my slides? No? Okay, it's gonna make me go back in. Okay, so from a sole proprietor perspective, this is the statement of business activities. So this is, many of you may have seen it, or your accountant completes it for you, but this is the tax form that you complete annually currently. So you do the regular portion of the tax return, and then this is a section within it that you report all of your business activity on. So you'd have your personal information, then there's the sales section, and then there's the expense section. So, you've seen all these expenses before: advertising, meals, insurance, everything there. And then from there would be a profit determined, which is calculated based on sales minus expenses, and you'd pay tax on that. But from the corporate tax form, it looks a little bit more like if you've taken any accounting courses in university, what you would see. So you firstly have to report the income statement. So you would have to have actual financials from an accounting software to populate the fields that are required here. So you have to report all your revenue, your cost of goods, which you most likely wouldn't have because you're providing a service, not a product, your operating expenses, and their Jiffy codes. So these are Jiffy codes required by CRA, and if you're using a software, they usually are provided for you. And then the other two sections here are related to farming. So this would be your profit and loss statement, income statement, and it'll be your revenue minus your expenses. Then you also have to do balance sheet. So this is where you provide all the other information regarding who you owe, who owes you, what you own, all of your assets, anybody who's got equity in the business, shareholders, your retained earnings, as well as all prior year information. So if these items don't balance, so something is off, or balance sheet comprehension is, it's probably one of the harder. I teach an accounting course, and sometimes even after 40 hours in, there are folks that the balance sheet is just, it's not happening for them. This is significantly more complex, and the debits and credits absolutely have to balance, or it won't be received from CRA. So it'll be rejected until this form balances. And this form absolutely provides a lot of complexity, and it's kind of stressful if you're doing it yourself. So this is sort of the justification from accounting firms to charge more for this process versus the sole proprietor process. So we just got really good at balance sheet, charge more. I think that was the. All right, so maybe I'll give the floor to you folks if you have some questions, or I brought up something that needs more explanation.
Hey, Stephanie, thank you so much for your time.
No problem.
Yeah, I'm somewhat new to real estate, so This is a topic of conversation that I think almost everybody has an opinion on, as it can be quite complex. So I want to thank you for, as a professional, breaking that down for us. Definitely well worth the time. Thank you. Yeah, and wondering if you could leave your contact information, as that I could reach out to you if I have any further questions.
Oh,
or
absolutely.
things like that. That'd be great. Yeah. Thank you.
No problem. I'll put it in the chat.
So I've always heard, like, through my accountant, like, there's the magic number, which I think now you're saying is like for gross earnings, if you're consistently above 96, like in the 100K range, like that's where you should net.
That's my preference, because the cost of living in Nova Scotia is higher now, but that is like the third tax bracket, so we're getting in the 30s here. So unless you need that to live, so it is, thank you for clarifying, it is net. Not gross. Okay. So after expenses, you're bringing in 96, but you need 60 to live, incorporate right away.
Okay.
And I just put my contact in the chat. I'm going to also leave you the slides, because that incorporation process is on there if you want to navigate that yourself. I wished that I had known that earlier, because I have a few clients we spent a lot of lawyer fees on, and it really wasn't necessary for what we were doing for our purposes. We were strictly incorporating for tax savings, not because of any liability reasons or anything else.
So what I'm hearing you say, Stephanie, in terms of that and incorporating yourself, is if you don't need legal advice on it, but you've talked to your accountant, then that's
absolutely
a perfect opportunity to be able to save the legal fees that are attached to it.
Absolutely.
Okay. And because then it will just be the yearly fee when your accountant does your additional taxes, all the extra work that's included in.
That's right. So your minimum $400 tax return, you'll have the RJSC will be $274, the registry of joint stocks. I don't know if some of you may be registered with registry. I see that it's a little inconsistent in the industry. Some are, some aren't. CRA doesn't care if you are or you aren't. They want your tax money regardless. So if you are registered with registry of joint stocks as a partnership or a sole proprietor, you're probably paying somewhere like $68.55. The renewal for incorporations is $274.10. So there's that ongoing cost as well. I could probably keep going on about costs for a while.
All those little incremental costs, or seem like they're incremental costs, that really add up.
They do. They do, because if you're, now if we're getting into bookkeeping and you're required to have a balance sheet, chances are Excel's not going to cut it. So you're onto QuickBooks or Sage or something like that, and that's like $600 a year. Well, if you're working with a professional though, that should be covered in whatever expense you're incurring from them. But I love to encourage the DIY bookkeeping.
I love to encourage my bookkeeper to do it.
I don't blame you. I don't blame you.
Yeah, my husband could do it. That's definitely more his strength than mine, but yeah.
I'd be in jail if my husband did mine.
Probably not a good spot for you to be in.
No, definitely not. Any other questions? Lovely. Is anybody going to incorporate? Turn everybody off?
Not right now.
That's a good answer. Honestly, it very likely is premature if you're not netting out over 100K. At that time, you definitely want to have the conversation.
Mm-hmm. So here's a question, Stephanie. If somebody is incorporated and then they decide they're going to semi-retire, kind of pull back from their business, I know because somebody was talking to me about that. At what point do you unincorporate? Do you just stop paying your incorporation fees?
Yeah, there's actually a full legal process to dissolving an incorporation, which is significantly more costly than incorporating in the first place. It's like anywhere from $3,000 to $5,000. And CRA will look for a tax return from you every year until that process has been completed. And even if you pass away, your corporation is a separate entity from yourself, so it lives on until this process has been completed. So I have seen people do exactly what you're saying and stop paying their fee, so it goes into default with CorpsCan as well as the RJSC. That doesn't stop your CRA problem. That said,
Okay.
it's not that complex to submit a zero return year after year. Put your name, your business name, and the fiscal year date, and then the business number, and send that in, and CRA is fine with it. But there's definitely a closing procedure that is complex as
So
well.
you could do that, but then once you pass away, then
Now somebody else's problem, your estate's problem.
your estate, right?
Yeah.
Okay. That's interesting.
Yeah,
I
I had one client, we absolutely had to do it because he wanted to use the losses for something else, for personal use. So the only way to get losses from a corporation is a dissolved corporation, and it's exactly the same as if you've dealt with an estate before at all, or know someone who's passed away, and you have to run an advertisement in like the Royal Gazette as well as another publication. They would have to do that for the even if you haven't passed, just closing or dissolving a corporation in general requires that process, so that collectors or folks you owe money to have the opportunity to collect it before it's dissolved, because once the dissolution is approved, all liabilities are gone with it.
Okay, interesting.
All right, so no other questions.
Wow, it's a quiet group today.
It is. That's all right. I scared everybody with my
No, you just covered everything. You answered all their questions before they could ask them.
Yeah, I thought it was a lot lower, because I was kind of told, and like you said to start, like, don't listen to people. Because I was pretty much under the understanding that once you start grossing 6 figures consistently, then incorporate.
No, net, definitely.
Net.
And it's interesting that like just something such what seems minor detail could, get you in over your head for no reason, or in a situation you don't need to be for no reason. And that's why it's often worth the 1-hour consultation, even if you don't use the accountant to incorporate or the lawyer. I wouldn't use a lawyer for any of what I assume you all do. You sell property, you get a T4A from Keller Williams, you put your expenses against it, and your accountant sends in a tax return at the end of the year. If you've got other businesses and things are more complex than the service you provide, absolutely you may want to consult the lawyer, especially if you're heading into an industry that has some liability. And if you don't separate yourself from your business, if you got sued, they could, the earnings from Keller Williams would be up for grabs. So there's that portion, which isn't my expertise. I just deal with the money side, and net is where it's at. You gotta watch the net. That's what you pay tax on, the net. All right, so I will, it's not letting me upload my documents in the chat, so maybe I could just forward them to you, Erin, and
yeah, so I'm not Erin, but yes, I'm Janice.
Oh, I've been talking to Erin the whole time, and I just assumed you were her. Janice, my apologies.
Oh, no worries. Erin wasn't able to make it. She had it was double booked for her. So
gotcha.
She asked if I could jump on and host it for KW. So yeah, absolutely.
Lovely. Okay,
So,
well, I'll send them.
If you send them off to Erin, that would be fantastic, and she will make sure that they get emailed out.
All right, that's fantastic.
Wonderful.
Well, I just want to thank you for having me, and I really appreciate the opportunity to work on my public speaking skills. And this stuff is super, I'm very passionate about it, so it was my pleasure entirely.
Awesome. Well, it's so great, and lots of great information, and it's great for people to have your contact info to be able to reach out to you for any additional questions or specific to their business that they might have.
Absolutely.
Yeah.
Thank you so much.
Thanks,
Thank you.
Stephanie.
Appreciate it.
Bye.